Hello, and a very warm welcome to all of you joining today's webinar. I'm Ben Simmons and serve as the head of the Green Growth Knowledge Partnership Secretariat. Today's webinar is the 9th in our Sustainability After COVID-19 series and asks our impressive panel of global experts the question, how can private finance support a sustainable recovery? Before turning it over to the moderator for today's event, a few comments on webinar logistics. First, we encourage you, of course, to make comments throughout the webinar through the questions box. This allows you to engage directly with the panelists. And of course, we're also recording today's webinar along with all the recordings of previous webinars in this series. And these are available on our website at ggkp.org. After the webinar, we would appreciate it if you could take a few minutes to complete our short survey. The feedback certainly helps us shape our future webinars. Finally, I wanted to let you know that our 10th and final webinar in this series will take place next week at the same time and will focus on the fiscal stimulus packages that form the core of the COVID-19 responses by governments. Panel experts will be exploring the role these measures can and should play in securing a green and inclusive recovery. We certainly hope that you're also able to join us for this final event. It is now my great pleasure to introduce Vikram Wij, the moderator for today's event. Vikram is a senior advisor at the Climate Policy Institute and has a very long and distinguished career spanning 30 years in serving in multiple leadership roles in climate and development finance. He has a very long CV and bio, but I encourage you to take a look at his full biography on our website. Vikram, we are absolutely delighted that you're able to join us today and serve as the moderator for the event, and I am pleased to turn the virtual podium over to you.
Thank you so very much, Ben, and hello everyone. Thank you for joining us today, and thank you, of course, to GGKP for hosting us. As Ben said, my name is Vikram Wij, and I'm currently the senior advisor for climate finance at Climate Policy Initiative, which is an advisory and analytical organization working with governments, businesses, and financial institutions to drive economic growth while addressing climate change. Before I introduce the panelists, I'm going to take a few minutes to set the context. I think it's also appropriate to say that prior to joining CPI, I served as the global head of climate finance and policy at the International Finance Corporation and the private sector arm of the World Bank Group for many, many years, as Ben alluded to. Today, we face an unprecedented crisis in the wake of the COVID pandemic. As governments globally roll out plans and cash for economic stimulus and to enhance the social safety nets, it is prudent to ensure that these actions are also consistent with addressing the other global threat that is going to pretty much threaten our very civilization, and that is of catastrophic climate change. And undoubtedly, I think we're all in broad agreement that mitigating climate change and increasing climate resilience will itself play an important role in securing a healthy environment and in reducing the global health burden we are all currently facing. At CPI, we've been making the argument for a while that the effective use of public and private resources must accelerate. It's not sufficient any longer to focus on only increasing green finance. It's time that we fully aligned all investments, including investor portfolios and all sort of bank lending, with a low carbon resilient transition. We're going to hear a lot more about that from our panelists. For context, CPI puts out something called the Global Climate Finance Landscape, which provides the most comprehensive overview of global climate-related primary investments. The most recent one captured a 6-year trend, including the first major wave of investments that followed the ratification of the Paris Agreement. A few highlights from that. In 2017-2018, which is sort of the last period it captures, the annual climate finance, which is essentially all flows related to climate, crossed the $500 billion mark for the first time. The annual flows are about $580 billion on average for each year across those 2 years. And so while this was a 25% increase from the previous 2 years, it is significantly below the $1.5 to $2 trillion needed annually for transition to a low carbon world. The estimate varies from different sort of perspectives and think tanks. So while we are seeing this steady increase in financing across nearly all types of investors, private finance itself, which is a significant part of this 580 billion at more than 55% in fact of the tracked flows, still remains to be fully unlocked. Global savings, these are the pension funds, the other institutional investors, are still effectively missing in action. I don't mean that they are not active. That is not from an advocacy or a commitment perspective, but certainly from a deployment of dollars perspective. There are lots of good reasons for it. There are structural issues, there are risk issues, some of which we'll explore. But at the end of the day, that is a pool we need to unlock since it is worth trillions of dollars. Commercial banks, by the same sort of benchmark, are also sub-potential despite making major commitments. I guess it's all how you count it, but in the way you count flows, they are very small. And finally, I think it's also worth noting, given the current context, that adaptation finance is quite low at barely 5%. And this is key as we refocus on resilience in the context of the recovery that will follow this pandemic, and which will require a holistic approach that connects climate action across the economy to issues such as food security, health, social safety net improvement, and of course, the gender-related impacts, which we must continue to focus on. So mainstreaming climate action into regular decision-making is obviously even more the need of the day. And while many might see the private sector's main role as a recipient of this government stimulus, in fact, business and finance have a key role to play. In particular, I think the financial sector must ensure that investment capital doesn't flow into creating or sustaining assets that are likely to be stranded in the near or medium term. And in addition to accelerating the shift to a low carbon resilient economy that is already being supported by capital markets, asset owners and managers should ensure that investment actually flows into sectors that will create the most jobs today, like in clean energy, in green construction, as well as in transportation. All this will also make society more resilient to climate change. The COVID crisis is also putting a spotlight on long-term resilience into portfolios, and therefore on the importance of robust risk management processes. Financial institutions will more than ever are likely to increasingly consider climate-related and biodiversity and other nature-based risks and opportunities in their investment decisions. So climate-related risk disclosure will become an even more universal issue. And we should hear a little bit more about that from our panelists. So it say that addressing the COVID-19 pandemic is going to require global action, and long-term solutions can only be found through innovation and global cooperation, and of course, finance. So all this is to say that I'm very pleased that we are all here today for this discussion with this excellent set of panelists who are practitioners from various corners of the private and commercial finance world, and who will help us drive this conversation forward. But before I introduce them and we get the discussion going, a quick housekeeping note from my side to say that we've saved a decent amount of time for audience Q&A during sort of the discussion. We are not going to wait all the way to the end. So after a couple of rounds of commentary from the panel, I hope to break on about the hour in about 50, 55 minutes, maybe 5 minutes after the hour. Let's see how it goes. And then we'll spend some time on having these pros respond to some of your questions. So as Ben already said, please feel free to use the chat box to type your questions throughout the session, and these wonderful organizers will help curate them. And so now, without further ado, I'd like to introduce you to this great panel we have with us today, introduced in the order they will speak, at least initially. Mark Lewis is the Global Head of Sustainability Research at BNP Paribas Asset Management, as well as a member of the Task Force on Climate-Related Financial Disclosures. Manju Sale is the Head of Sustainable Finance Advisory at BMO Capital Markets, where she provides thought leadership on the topic to corporate and institutional clients. She has over 20 years of professional experience and led what is relevant to this conversation, the establishment of BMO's Sustainable Bond Program with the issuance of their first sustainability bond late last year. Dorothy Maseke is the Group Head of Risk and Compliance at ICEA LION Group. They are one of the largest financial services groups in East Africa, with interests spanning life assurance, health and property insurance, and asset management, all relevant to today's conversation. Mary Leung is the Head of Advocacy in Asia Pacific at the CFA Institute. As many of you already probably know, the CFA Institute is a global professional and credentialing organization best known for its CFA charter. Mary is an advocate on issues relating to corporate governance, investor protection, and the integration of ESG factors into investment analysis, not to forget the availability of reliable ESG data to be able to do this. And finally, Marcin Bill, who's a senior financial officer at the International Finance Corporation, my most recent past employer, and has led the issuance of green and social bonds for IFC across both developed and developing capital markets since 2013. So with that, let me set the panel off by asking how ESG investing, which has obviously been picking up momentum in these past several years, is emerging and evolving to help us build better back from COVID. There are new paradigms for the ESG metrics with focus on social. There are commitments to net zero investment portfolios. We are beginning to see increased stewardship, shifts in investment decision-making processes that hopefully will sustain and permeate. So Mark, you've been an analyst at a bank advising clients on your utility sector and more, then at Carbon Tracker, and now providing your insights to your clients whose assets BNP Paribas manages. What's your take on the shift in momentum in ESG investing, and while you're at it, for good measure on TCFD disclosure, given your role there?
Yes. Well, thank you very much, Vikram, and pleasure to be here this afternoon. Thanks to the GGKP for the invitation to participate in today's webinar. And all those questions you've just asked are very topical, clearly. But I think the first observation I would make is that, and you alluded to it there in your introduction, Vikram, is that the COVID pandemic and the crisis it has precipitated has not come in a vacuum. There's a context here around the evolution of ESG investing over the last few years. But I think the first observation I would make is that the pandemic and the global response to it is likely to accelerate the speed with which ESG becomes part of the mainstream in terms of investing. What I mean by that is, just very quickly in terms of some historical context, as recently as 5 years ago, ESG was still considered very much a niche activity, even in Europe, which has been in the vanguard of developing ESG investment techniques globally. And typically, most institutional asset managers, to the extent they had ESG funds, or what were also known as SRI funds, were managed apart from the mainstream portfolios, and indeed the ESG teams within large institutional investors were apart from the rest of the mainstream. I think the most striking development of the last 18 months, 2 years, and we're seeing more and more institutional fund managers adopt this practice, is to start integrating ESG factors into the analysis of portfolios, not only in terms of the dedicated ESG or SRI portfolios, but across the whole asset base under management. Let me give you a concrete example with regard to BNP Paribas Asset Management. We manage about 450 billion euros across equities, fixed income, infrastructure, and private debt. And at the moment, about 50 billion of that is in these dedicated SRI funds, which is how the industry has evolved until now. And the investors who place their money in those kinds of funds, dedicated SRI funds, are really looking to align their values with their investments. The proposition now that we are making to all of our clients is that, so the remaining, we have about 50 billion in those dedicated SRI funds. We're now saying for the remaining 400 billion, we are going to integrate ESG into all of those portfolios, whether it be equities, whether it be fixed income, whether it be infrastructure, private debt, because we think that taking ESG into account will improve the financial performance of our mainstream clients, whether they believe in ESG or not. So the philosophical proposition that we are putting to our clients now is taking these factors into account will improve the financial performance of your investments over time. And I think that is, more than anything else, a clear signal to the market that we and an increasing number of other large asset managers view the integration of environmental, social and governance factors as crucial to the long-term financial performance of these investments. And so that's the first observation I would make. I think this is a very exciting time, and the industry had been moving in this direction anyway before the COVID pandemic came along. Now, what the COVID pandemic does is, I think, to accelerate that trend. And indeed, I was very interested and very gratified, given that I read it this morning and thought I'd be able to use this in my comments this afternoon for this webinar, to see a piece of research from the broker JP Morgan this morning, saying that not only are we seeing continuing a more rapid inflow of funds into ESG strategies as opposed to mainstream strategies, but the performance of ESG funds since the COVID pandemic struck has generally been better than the performance of mainstream funds. So this is further proof that the impact of the pandemic will focus investors' attention on the attractions of ESG investing, because the performance has actually been very good. Now, it will vary across the piece, but one very obvious example that I track very closely, being first and foremost an energy and climate specialist, is that the volatility that we've seen recently in commodity markets and in oil markets in particular has meant that the oil sector has suffered very badly during the course of this pandemic. And many ESG strategies, of course, penalize oil companies in portfolios because of their very large carbon footprint. And therefore, ESG funds tend to underweight or exclude altogether, in some cases, oil and gas companies from the mix. Now, it just so happens that during the last 3 months, that would have been exactly the right strategy to pursue. So I think the best way to summarize this, Vikram, is to say that the COVID pandemic is accentuating trends that were already in place. If you think about climate change and the energy transition, there were a number of structural pressures there long before the COVID pandemic came through. Decarbonization, of course, the deflationary impact of renewable energy, the decentralization of energy that renewables make possible, and what I call the detoxification of air in the world's largest cities. This has become a very big problem globally, but particularly in the large cities of the developing world and Southeast Asia in particular. And we've all seen these pictures under the lockdowns of New Delhi and other places, pre-lockdown and post-lockdown, where all of a sudden the citizens in these large megalopolises in Southeast Asia are seeing blue skies and breathing clean air. The behavioral changes that many of us have had to make during the lockdown will leave a legacy, I think, because some of them will stick. There will be more working from home in the future than there was before the pandemic struck.
We lost you, Mark. Oh.
Hello?
Yeah, okay. We just briefly lost you there for a fleeting few seconds, yeah.
Okay, well, the point I was making, and I'm coming to a conclusion now, but the point I was essentially making is behavioral changes under this pandemic will accentuate those long-term structural pressures and in turn provide an impetus for governments and hence to investors as well to accelerate the greening of the global energy system. That's one particular example. If you look at the European Union, 750 billion of stimulus funding for the European economy, and 25% of that large number will go specifically on greening the European energy system. That provides great investment opportunity for the private sector and for institutional investors such as ourselves. And one final point I would make, when you really boil it all down, what you have in the proposition, the investment proposition of clean energy and renewable energy as compared with fossil fuel energy is you're investing in a visible stream of earnings. Renewable energy projects give you long-term visibility on the earnings profile of that project over a 15-20-year period. As I said a few moments ago, the key characteristic that we've seen highlighted under this pandemic of oil markets is the tremendous price volatility. And I think investors are seeing more clearly than ever now, subsequent to this pandemic and the lockdown, the attractions of the visibility of earnings under green energy projects and the volatility of earnings under traditional fossil fuel projects. And financial markets prefer visibility to volatility, and you're seeing that coming out now in the valuations that stock markets globally are giving to renewable energy companies versus fossil fuel companies. So I think this is an exciting opportunity for the world to accelerate the energy transition and to raise the profile not only of the E pillar, but the S pillar as well as we move forward.
I'm glad you mentioned those couple of things, E and S. Somebody on the chat asked what's ESG. I'm hoping that we're not going to spend our time defining the parameters, but just for the layman, I'm going to say it's environmental, social, and governance, where governance has been pretty prominent in a lot of investment activity, but the environment and social is what really, as Mark highlighted, what we're going to focus on here. Mark, you also mentioned the whole thing about Delhi and cities like that where people actually witnessed clear skies. That's all gone, right? As the lockdown has lifted, you're hearing reports that, so one can only hope that between better performance of ESG oriented funds and the memory of clean air by the denizens of these cities and countries remains as a dual pressure on governments to continue to actually influence how policy is going to evolve and develop. But with that, I'm actually going to transition to Manju. Manju, we heard from Mark that the sell side's active, the ENS bits. Let me ask you, what is it that you're seeing on the ENS front that is particularly different from the great financial crisis of 2008 and since, from your banker's perspective, if you will? So over to you, Manju.
Thank you, Vikram. It's really fantastic to be here today with all of you, and happy to participate with this distinguished panel. And let me start off by saying that, this is a low probability, high consequence event that we are all facing. So the COVID pandemic has really brought to the forefront in many different ways what are the impacts in both the environmental, social dimensions of our life. So if there is a silver lining in some sense, we have flattened the experience that, to some extent, not fully obviously, what a billionaire is having to face in the pandemic, as well as the migrant population or people who are very poor is also having to face. So in some sense, we are all worried about our health as well as our safety, and so that is the one aspect of this this crisis, which is very different from the 2008 crisis, because that, I think, was reflected, started off in a financial system, and then spread out to other parts of our experiences. But this one is something that started external to the financial system, and then has proceeded to impact every aspect of our lives and the various dimensions that we are operating in. I think one of the fascinating things that we are all observing, if you're not in the midst of it, at least as an observer, one could say, businesses are having to think about what it means to have a social license to operate, right? So we are seeing over 10 million cases of COVID around the world. We have seen over 100,000 deaths in USA already. And depending on what countries are doing nationally is impacting what are the sort of the impacts from that and the responses from that. In terms of the capital markets, what we have seen is that there has been a huge issuance of social bonds, which is initially was something that perhaps many had not expected, but it was very clear to many practitioners that that could and should happen, because this is a crisis that if we need to provide capital, then it means that social bond is a great instrument to issue. But so let's take a step back and see what happened in 2019. So the sustainable debt issuance in 2019, by end of 2019, we saw a cumulative sustainable debt issuance of about 1.2 trillion. We saw that there was about $330 billion in issuance of green, social, and sustainability bonds, as well as green loans. There was about 125 billion in sustainability-linked loans, and so that essentially was a huge total uptick from the previous year. This year to date, we have seen already about 32 billion in social bonds issued, which is compared to 16 billion all of 2019, has already surpassed by a great amount. We are double of what we issued social bonds in all of last year. All of that is to say that represents and indicates that there is a big recognition that social bonds is something that is an instrument that can be utilized for the pandemic. We've also seen that year to date, green, social, and sustainability bonds, there has been roughly about 136 billion issued. So this again are all indications that the capital markets is leaning into these products to really provide capital to governments, to countries, as well as corporations in terms of facing the pandemic. There has been talking of labeling. So when we talk about pandemic bonds, they have come out in all sorts of labels, but most of them have been aligned to ICMA's social bond principles or sustainability bond principles. And for our viewers here who may not be familiar, green bonds essentially are bonds that have underlying, the use of proceeds have projects underlying that benefit environmentally. Social bonds have social benefits, and sustainability bonds have both either environmental or social projects underlying them. And so in all of these issuances that we have seen across the board, the labeling can sometimes may not be very clear, but you have seen, for example, IBRD Sustainable Development Bonds. You have seen IADB Sustainable Development Bonds during this pandemic. We have seen IFC issue several social bonds. African Development Bank came out with a $3 billion social bond. EIB came out with a Corona Sustainability Awareness Bond. And we also had a social inclusion bond from CEB. So there has been all these various types of bonds that have hit the market. And I hope that this provides a great window into investors, into bankers, into thinking, how to access capital for social impacts. SDGs is something that came into the play for about a few years now, but there has been, I would say, overall a bit of a hesitance in embracing bonds and instruments that really try to focus on impacting social causes. And for that, I would say, one way to overcome the way of thinking around it is that a lot of the decision making that goes around to bringing social benefits through these instruments are backed by facts and science. And so to the extent we can pivot into thinking that social bonds can be a way of moving forward along with green bonds and some of these other instruments, that would be great. So in terms of ESG investing, it has typically been viewed as a defensive approach. And we're seeing that during the coronavirus pandemic as a stress test. This is, as Mark just mentioned, a lot of the funds have shown that they are performing better, but we will hold our final thoughts on that in the next 8-9 months or to a year, because I think this pandemic is going to play out in the next 18 to 24 months during this period of prolonged uncertainty. And so I think how the ESG investing is being held to test is that earlier comment I made, where businesses are having to face what is their social license to operate. And so are they really influencing policies and actions of their portfolio companies is going to be assessed and tracked. So for example, Just Capital has a tracker that it's focused on. So I think the other aspect of this is the ESG investing is how are we deploying capital to address some of the global challenges. So from the capital markets perspective,
we're gonna have to wrap up soon, please.
Sure.
Yeah.
So from the capital, so my last comment would be that from the capital markets perspective, I think the more we connect both the buy side and the sell side, I think there would be a larger sort of forward-taking step in terms of bringing impactful solutions towards the facing the pandemic.
Great, thank you. And sorry to interrupt you, but just a heads up to the other panelists. I'm not going to take away from your time and your prepared remarks, at least in the first round. Just be forewarned, the longer we take in this round, the lesser time we're going to have for round two. So I'm going to hold all my penalties for round two. Okay, great. With that, I'm going to start. I'm going to turn to Dorothy. Dorothy, can we get an emerging markets perspective from you? You've heard Mark, you've heard Manju. There's a lot going on in the capital markets. ESG is not only the flavor of the day, hopefully it'll sustain. But tell me, are you seeing the same surge in ESG investing in your environment? And particularly, and it might be interesting to the audience given some of the questions that are popping up, and we'll talk about those later. As an insurer, are you starting to see a particular way that ESG risks might be getting addressed? I mean, you can sort of take it whichever way you want, but we'd love to hear your reaction from that perspective. Thank you.
Well, thank you very much, Vikram. I just want to pull in from what Manju has talked about. She's talked about the social license to operate. And from the perspective within this particular area, I want to say that ESG is still at quite a nascent stage, I must say. What we are seeing now, by saying it's at a nascent stage doesn't mean that there is no, focus on it. There's a lot of focus, there's a lot of discussion, there's a lot of task force, there's a lot that is going on. But just let me paint a picture briefly of what we have back in Africa. So look at the social and demographic makeup. 60% of the population is estimated to be around, under the age of 25. 41% being way younger than 50. This is a very young, a very active population. Now, much of the economies, many of the economies within this, region are actually highly dependent on natural resources. So I'll take an example of Kenya. About 50% of our country's GDP is directly attributed to sectors that are reliant on natural resources. That's agriculture, that's forestry, manufacturing, energy, etc. Now, what does that mean? It means climate change issues, extreme weather events, etc. could cost us quite, a huge sum. Actually, the last estimates are at about 1% of the annual GDP. Now, come COVID-19, which adds another dimension. So, looking at this ESG investing is basically one of the key ways of building resilience. But then going back to your question, Vikram, what are we seeing even from the insurance point of view? Now, there's a lot of discussion. A number of companies in Africa specifically, in South Africa, West Africa, and even East Africa, ICEA LION being one of them, we are now getting into sustainable insurance. So we at ICEA LION have, were the first signatories in East and Central Africa to sign on to the PSI, UNEP PSI, and this basically just indicates that we are committing to sustainable insurance. And with sustainable insurance, we're talking about social nets, social safety nets. How do you ensure that population that is most vulnerable? Number two, how do you create new products to address climate change issues, flooding risks, for example, drought, food security issues? What kind of products do you have, or do we have, or do we bring to the market to actually, provide this resilience that is much needed now? So going specifically to, the bond market and what Manju and the rest of the team has talked about, the rest of the panelists, we are still quite behind. We are seeing a lot of focus and a lot of, such bonds being issued in Nigeria. We've seen a lot in South Africa. In Kenya, we've just, floated our first green bond January this year. There were intentions to have a sovereign, green bond. Haven't quite worked at this point, but we are behind. But there's a lot of interest. There's a lot of potential. Now, there are a number of challenges, which of course we'll talk about later. But again, looking at the various jurisdictions, there are issues on government action or inaction, if I may put it as that. Creativity in structuring this investment mechanism. The most important is awareness, So even where I work at ICEA LION, it is now that institutional investors are asking the ESG question. And well, as a group, we have taken the proactive approach to, to have these processes in place way before we get these questions or these demands by, pension funds and institutional investors. But the point is this: not many are actually very clear on what ESG is. So when you see the question on the chat, it's a very genuine concern, a very genuine question. So the key driver, the key thing that we need is ESG going beyond being the flavor of the month, as you called it, Vikram, but more into awareness, so that every person, every individual, every key component or entity within the value chain can really understand what ESG is, what it should do, what the capabilities, and drawing from experience from external markets. I think that should actually take us to a better place. So the conversations are going on quite well. But now we are at that point where we need a lot of awareness, and we need these kind of forums to bring this conversation to this particular, space.
Thank you so much, Dorothy, both for your comments and your complete focus and precision on time. Appreciate that. Mary, just building on what Dorothy said from sort of a developing country region perspective, ESG awareness, particularly ENS awareness, as we've been talking about here, related to investing, is coming into vogue. It's sort of now, hopefully, more than the flavor of the month in Asia. There's a lot of new funds are getting launched, and there's a lot of activity there. What's your take on investing and stewardship in the Asia Pacific region around this?
Well, let's put it into context, right? Before this year, I think the ENS in Asia was bubbling along the surface. It has been a somewhat slow-moving train. It was fashionable to some, but not to all. And then the COVID crisis hit. It was fast. It was evident. It was passing. But if you look at the climate side of things, it's relatively slow. It's still contested in some parts of this region, and it's impersonal. So, we will look, like you said, how has it changed the momentum of the ENS, and how does governance fit into this? And in the last few months, the CFA Institute in APAC has been organizing webinars with our members and candidates on ESG. And each time we poll our audience, who are mostly in the investment profession, on this question: will the march towards sustainability and ESG investing be derailed? How has the pandemic changed that? And in 2 out of 3 scenarios, the majority of the audience thought that the pandemic actually reinforced the importance of ESG. However, there are investors who felt that if asset values were cheap enough, there would be many more choices, and they would go bargain hunting. Now, a bit of health warning. For Asia Pacific, it's a really, really fragmented region. You have, on the one hand, mature markets such as Japan, Australia, New Zealand, Hong Kong, Singapore, and Korea. And then you have some behemoths like China and India. They are in a class of their own with huge internal variations. And then you have a swathe of other emerging frontier markets, somewhat established, like Thailand, which is actually a bit of a pioneer in ESG, Indonesia and the Philippines. And then you have frontier markets like Myanmar and Cambodia and Vietnam. So it's very, very difficult to paint Asia or Asia Pacific with one single brush. On top of that, unlike Europe has the Union, and which has demonstrated leadership in policy setting with the Green Deal. In APAC, there is no APAC Union, right? There's no pan-APAC regulator. There's no pan-APAC central bank. So it's difficult to generalize, but I'm going to try. Okay. If you look at the GSIA research from last year, they put global ESG AUM at $31 trillion US. They also surveyed key centers of activity in Asia Pacific, namely Australia, New Zealand, and Japan. And those numbers came up to be 10% or less than 10% of this 31 trillion. But if you look at APAC, it's 60% of global population, 40% of global GDP. And yet when it comes to ESG investing, it's less than 10%. Now, obviously, there's some caveat with that number because they're really only looking at the key centers of activity. But you add some numbers, you include some countries in the top and in the bottom, it's not going to move the needle. But so what are the challenges in APAC in terms of doing ESG? And in a project we did with PRI globally last year, we visited 10 locations across APAC, and we asked investment professionals about the challenges they were facing in integrating material ESG factors. And there were some consistent themes. Firstly, confusion. What does ESG really mean? Your ESG is probably different to mine, different to Dorothy's. And does ESG mean lower returns? Am I going to sacrifice my performance? And I think to that respect, what we're seeing over the COVID crisis and what Mark was saying about moving all their assets into ESG integration is highly encouraging. A third challenge is about data. Where do we get reliable, consistent, comparable data? And a very unique thing about Asia Pacific that we were hearing was that there's a lack of talent. Where do we get these professionals from? I've had teams telling me that they wanted to double their size, but they just can't find the people. And the last thing is on client demand. It can be a driver when there are lots of it, but when there is insufficient client demand, it hinders progress. And if you look at the investment food chain, who sits at the top? Asset owners. And we need more, and that is something that is coming along, but not quite there. But despite these challenges, I am very optimistic that sustainability will come back stronger. Why? We have some powerful disruptors at play. COVID-19 crisis has demonstrated how interconnected we all are, and that we can't kind of afford to muck around in one part of the society and think that we can get away with it, right? And it seems that ESG portfolios have held up pretty well for now, despite the recent market volatility. So that's one reason. Another is Asia population tends to be quite young. Okay, we're talking about Gen Z who focus on values, who embrace technology, which in themselves provide huge opportunities for innovation. How do you stay in touch with your clients during the lockdown, right? So it spurs innovation. And number 3, asset owners, I know they haven't really been there, some have, but they're increasingly becoming assertive. But lastly, I think what's interesting in Asia is the regulation, the regulatory intervention. We're seeing increased disclosure requirements by issuers because regulators are tightening the score. We're seeing standards going from voluntary to comply or explain, and with some mandatory elements. So that's quite interesting. We are seeing a huge amount of the volume of disclosures going up. Quality is not quite there yet, but we're getting there. Like you said, Vikram, I'm glad you talked about stewardship. Stewardship requirements is also increasing. After the UK upgraded their stewardship code for 2020, we've seen similar upgrades in Japan and Taiwan. And the key change is the explicit reference to sustainability and environmental and social benefits. There are also initiatives by stock exchanges and regulators in Hong Kong and Singapore. Hong Kong last year upgraded their ESG disclosure standards. And more interestingly, just last week, they launched a sustainable and green exchange called SAGE. And it's a new information platform which will act as a central hub for data and information on sustainable and green finance investments in the region. So that's quite interesting. And Singapore is probably one of the most proactive governments in the region. They're committing huge amounts of money to drive sustainability and green finance. They are providing tax incentives and fee rebates to green bond issuers. And just last week, they published a consultation paper on environmental risk management across the banking, insurance, and asset management industries. So a lot of top-down policies and bottom-up efforts. And I think this is why I think sustainability will be back stronger, better in APAC. But I have to admit that there will be significant challenges. We have to recognize that while this has devastated many economies and there will be recovery, it will be uneven. But it's an opportunity for us to build in a way that's sustainable. It's an opportunity for companies to reset their strategy and an opportunity for finance to accelerate this change. And it's something that we can't afford to miss.
Thank you, Mary. Thank you. A lot of good stuff there. I just wanted what struck me between what you said and what Dorothy said earlier between the youth and the Gen Z, we're going to rely a lot on this. I don't know how many of them are out of the many in the audience, but I hope they're taking note. We're going to have to rest on their shoulders at this point. No pressure, people. Okay, on that note, actually, it's a perfect segue from, given all the discussion around transparency and impact, perhaps for us to sort of segue to a discussion with Martin leading us on how green and social bonds are they up to the task of providing the longer term financing, particularly for a just transition. And we've heard from Manju earlier, and we've seen in the press, social bonds are amongst the fastest growing sustainable finance product at this point. The importance of standards, transparency, positive impact all become kind of critical. So Martin, this is like as an issuer and as an influencer that IFC is and you are on the green and social bond principles, how are you looking at this? What is your take on the role of green, social, sustainability linked bonds, which was sort of the most recent advent in the market? So over to you, sir.
Thank you, Vikram. So yeah, we'd like to think about the way we engage in this market in a way providing a signaling effect to the broader corporate universe of issuers, and in particular the focus on fixed income market. We have been issuing green bonds and social bonds since 2013, and there are positive developments in this market following the COVID-19 pandemics as well. I'd like to highlight perhaps three to start off that, in my mind, will have a big influence going forward. One is change in the language of social bond principles, which have been updated after a year of being in the same state. They are being recurrently updated. they have basically been broadened up to include the general public being affected by the events like the current pandemics, as opposed to previously targeting specific populations. The other one is development and launch of sustainability-linked bond principles, which and Manju mentioned that there's been a lot of taxonomies and names being thrown around. So perhaps this is worthwhile straightening up. There are sustainability bonds out there who are generally issued against the sustainable development goals. There are social bonds which work under the social bond principles created by ICMA, and there now have been, and they have existed for a while but haven't been regulated in that format, sustainability linked bonds. So these are the bonds that are basically their performance is dependent on achieving specific objectives, and in that way they differ from sustainability bonds, if you will. That does create, a bit of complication in terms of understanding the complexities of that market. But since the introduction of green bond principles and social bond principles, these markets have developed quite rapidly, and this regulation helps investors create frameworks around committing money and measuring outcomes, which is another aspect of, by the way, being developed quite aggressively on the social bond side, to be able to measure the outcomes of the projects that are financing, social type of issues. So this market is clearly evolving quite quickly. The big question around that exists, and we can talk about it, a bit later as well, is transparency versus development of that market. There is a lot of demand in that space for ESG type of products. At the same time, there is also demand for transparent reporting and transparent understanding of what the money is going to finance. At the same time, there are issuers, and there is discussions around evaluating issuer as an entity as opposed to specific bond that finances a particular project. And these two are developing in parallel, but at the same time, we do see a consistent and increasing demand for transparent reporting and need from investors to understand what it is that the money is actually flowing into. The third portion, I think it's part that's worthwhile mentioning, is the fact that the COVID-19 did help the S in ESG, so social type of or sustainable type of bond, make a leapfrog jump in terms of development. We have been involved in a number of capital markets, and there are at a different level of development in terms of volumes, in terms of liquidity provided, in terms of which types of bonds are being offered, and in terms of pricing as well. And this clearly has created a catalytical effect on the volumes that are being supplied into the market in that respect. IFC did issue in the midst of actually the crisis in March a social bond linked to actually financing COVID-19, and IFC, as a part of the World Bank Group, is now working to channel the demand that we're trying to, the supply of projects that we're trying to provide to our clients, and then coin it into bonds that we can issue in either social linked to COVID-19 related financing and green financing, which is a continuing project on our side. There is a specific target at IFC that needs to be met in terms of projects that are financing green types of endeavors. I guess one thing worth mentioning is that the World Bank Group overall, which IFC is a member of, is trying to fight the extreme poverty in the world, and the COVID-19 has resulted in, now the estimates are, an increase a projected increase in levels of extreme poverty going up by 70 to 100 million people in 2021. So with that, there's been an explicit package related to COVID-19 from the World Bank Group in the context of $14 billion, and now from IFC specifically in the context of $8 billion. There are 4 particular pillars of debt financing. One is the real sector crisis response facility. There is money that's going to be financing working capital for emerging market private corporations. There's global trade finance program. There's the global trade liquidity program and critical commodities financing program. So there's a number of initiatives that will and are already actually showing commitment and will result in disbursement. The other aspect is the taxonomy and regulation itself, and clearly there are developments. You know, Mary mentioned that Europe is quite organized in that fashion, and the European Parliament has adopted the taxonomy regulation on June 18th, so that's a big development and a standard. There are changes in China actually in terms of adopting the green financing and dropping fossil fuel related type projects from eligible projects that I believe was the case before, which is a huge development in my mind. There is the before mentioned the crisis recovery plan that EU has introduced, and 25% of that 750 billion will go or is intended to go towards the green types of projects. The important development is also the discussions around principles that the Principles for Responsible Investment have published a report on investing with SDG outcomes, and that a group of investors represent about $100 trillion in money, and that clearly is aligned with SDGs. So that report then creates certain framework for the investors to then follow and pursue this type of investments, which again, in my mind, will result in more dynamics, more support for thematic type of bonds in either shape or form. And lastly, ESG, and there was a question from the audience about what it is. Something that's worth stressing is that the discussions around ESG was the timing nature of it. So E as environment has the longer term results by definition, because it's just really hard to turn around the temperature increase globally. Social, midterm, if you will, and governance can be changed quite drastically and rapidly if only the government or regulators are willing. Clearly, we've seen some overnight almost changes in terms of E. Obviously, the temperature is still rising, but we can see what effect that drastic stoppage of traffic can have. Social, there's also a drastic jump and a leapfrog move, and then there is now a lot up to the governments, which are around the globe in many cases stepping up to the task and changing the regulations. I'll stop there, Vikram. Over to you.
Thank you so much. Cognizant of time, I'm going to just sort of build on that and go back to all the other speakers, man. I'll come back to you in a bit, March, and maybe if everybody can just keep their responses snappy to maybe a couple of minutes each, that'll allow us, and you can reserve some of that comments you had to some of the questions, some very good questions coming from the audience. The organizers are doing a fantastic job of curating them, but if any of you, if you want to track that, and that's why occasionally my eyes sort of flitter away from the screen, is because I'm also trying to track it. If there's a question you must answer, you really want to, dear panelists, flag it for me or in the sort of chat box to the organizers, and we'll get to that. Otherwise, there are 2 or 3 very good questions already lining up, and I know particularly Marcin has already raised his hand up. So I'm going to just build on what you said, Marcin. Turn to Manju briefly. You're an underwriter. You signed up for IFC's led impact management principles. It may not be the exact term, but you know what I mean. What's your take from a financial and sustainability perspective in particular, especially on this issue, the surge in social bonds, and what do you see in terms of reporting post-issuance? Over to you, Manju, for your expert insight on that. 2 minutes, please.
Sure, and I think I have a minute or two, if I heard you right. So yes, so I think what the reality is that the pandemic has you know has we've come to a point where we have some instruments, some ways of financing this crisis, but I wouldn't say that we were prepared to really kind of deal with this unprecedented situation. But having said that, I think some of the various instruments that Marcin also alluded to are all good tools in our arsenal, if you will, to actually address. So, for example, if we are thinking about in terms of the SDGs, what are some of the SDGs that in this crisis that we need to think about? So, obviously, like SDG 3, which is good health and well-being. We have SDG 4, which is quality education. SDG 6, water and sanitation. SDG 8, decent work and economic growth. And SDG 10, which is really important in my mind, which is reduce inequalities, and which also has been, really amplified sort of the disparities that we're going to see now going forward. For example, we've read lots of articles about the struggles of the migrant populations going back from cities to villages, and the kinds of experiences that they have had. We also need to think about how we are going to build a data-driven public health system, because that is the real true solution for us to face and react and respond in real time in terms of who's infected, or how do we quarantine, or how do we create isolation, how do we do contact tracing. So I just touched upon 6 SDGs, but these are huge opportunities for us to kind of think through and figure out, how we might, be better, create resilience, and how do we then think about, the future. We will be remiss if we don't also talk about the recent social unrest we've seen in the United States and around the world, and this call of, racial equity. This is the first time in, probably in many decades that we are seeing the word systemic racism being used over and over again. It's a deep concept, a huge topic. We don't have the forum here to talk about it, but I was really happy to see that Ford Foundation came out and issued $1 billion social bond. This was historic. This has never been done before. So these are the ways of the groundbreaking steps that we will have to take. I think we just can't depend on the amazing work that World Bank has done over the years, and other development banks and multilateral institutions that have done some of this work. But I think we have to go beyond that. And I think how do we participate and create, maybe partnerships, create opportunities where we are doing both social and green. So it's not just about green. And I think that's the great thing about this time now, because it really helps us create adaptation and find ways of doing green stimulus, for example. How do we do government spending? What kind of financial and tax incentives we can think about? What are the conditions we can create to actually bring forth the kind of change we're looking for? So with that, I'm going to stop there. But those are some of the ways to think about it.
Thank you, Manju. And I'm going to turn to Dorothy. Dorothy, I come back to you for a reality check on what Manju said. She built on what Marcin had said on the relevance of, you mentioned green bonds, Kenya's new sovereign bond issue. Okay, green bonds is coming, social bonds are emerging. What is the relevance of these instruments for a recovery and sort of strategy for Africa? If we can have some couple of minutes from you on that. Thank you.
Yes, so the relevance is this. So what does the potential say in Kenya hold? So looking at the demand side, we have the capital. There's a lot of liquidity in the market. I mean, the policy that the government has taken at this particular point has led to that. We have a very mature pension sector, estimated to about 15 billion USD, maybe a small figure to you all, but in this market, that's quite a huge one. We have a lot of potential in geothermal, hydro, wind, solar energy, need in housing. The government has come up with what you call the Big Four agenda, one of which housing, affordable housing is key. I mean, there's need for public transport and infrastructure development. Now that, of course, again, supported by the country's strategic plan. So there's the green economy strategy and implementation plan in addition to the Vision 2030. So in terms of the vision and in terms of the potential, it is there. But one of the things that, like I said earlier, there's a lot of activity, a lot of discussions ongoing. FSD, for example, I don't know if there are any one of them in the audience. FMO and Kenya Bankers Association are working on what have been supporting what you call the Kenya Green green bond platform. And this has really, done a lot, and they've been able to do quite a lot of work on that. They've been doing a lot of training sessions. They are working on policy and regulation, just lobbying on incentives to support this. So what we are saying is that the proposals, I mean, apart from that, there's been a proposal for a COVID bond, that has been discussed or that is being discussed, and mainly due to the social obligation and liquidity that we have in the market. So the market is ready. These kind of bonds would provide this financing, but then if you look at it, a lot has been done in other markets, and maybe as we go along, I'll be able to mention the green bonds program that I'm talking about. Nigeria, there's something they issued. It's actually AAA rated, I think by NSP, North South Power Company Limited, 15-year corporate infrastructure bond with a coupon rate of about 15.6%. I mean, this one scored, 12 institutional investors gave commitments, 9 pension funds, and it was oversubscribed at that particular point. So there's quite a lot of activity, like I said, and a lot of support again from IFC, from a number of these multilateral institutions.
Thank you, Dorothy. Mark, you mentioned the whole sell side waking up to this and actually going to this full force. What's your take? I mean, given the opportunity in emerging markets that Dorothy just reiterated, as in her word, the market is ready. Do you think the investors are ready? I mean, we heard there, is the change in investor behavior for socially responsible or ES portfolios, does that extend beyond OECD?
It's a great question. My tentative response would be yes. And I say that because, again, I can give an example from our own experience. At BNP Paribas Asset Management, earlier this year, we started to implement the coal exclusion policy that we announced last year. And that, in fact, has a bigger impact in our portfolios in emerging economies than it does in developed economies. Because we were not particularly exposed to coal in Europe, for example, but in the emerging markets debt portfolios, we were exposed to coal. And you're seeing, in particular, more and more asset managers exclude coal. That's the first step. I mean, I guess there's two sides to this coin. One is moving away from the old energy system, and the other is moving towards the new energy system. And that transition is happening at different speeds in different jurisdictions, but it's unmistakable everywhere. And the reason it's unmistakable everywhere now is that what has happened in the last 3-4 years in particular, and will continue to happen going forward, is that the economics of renewables have become mainstream. So renewables now, it's no longer, I mean, Manu made a very important point earlier, I thought, which I would just like to reiterate in this context, and that was that we are in a totally different situation from where we were in 2008, 2009, the last time probably that we saw a major global financial and economic crisis like this. And the reason it's very different from an energy point of view is that back then in 2009, the cost of renewables simply was not competitive with fossil fuels. And so when oil prices fell very dramatically, you remember in 2000, 2008, 2009, from nearly $150 a barrel to $30 a barrel over a 7-8 month period. It was a very tough moment. Climate change dropped down the policy-making agenda of many, many countries around the world, and it took time for that to come back. But in the meantime, the economics of renewables continued to improve. Here we are 10 years, 11 years later, and the cost of solar energy, to take just one obvious example, has fallen by 85 to 90% over the last decade. And in many emerging market economies, of course, the solar irradiation conditions, the natural conditions for solar are very attractive indeed in countries like Africa, Southeast Asia. So I would say the reason I said it's a tentative yes is that the economics are no longer in dispute. I mean, I think, look at the news we've been greeted with today. Shell, the largest European oil company, making an unprecedented write-down of over $20 billion on its oil and gas assets. BP 2 weeks ago, $17 billion. The stranded assets argument is real. We've been talking about that for literally for years. We're now seeing it. We're now seeing it being acknowledged by the accountants. It's actually been acknowledged by the market for a while now. You only have to look at the share prices of the big oil companies to see that. Accountants always run behind markets, but accountants, if you like, give the official stamp of authorization on it. And that's what we're starting to see now. That really tells you the economics have changed irretrievably now, I think. And renewables, the cost of renewables, I think what a lot of people don't fully appreciate yet is that with renewable energy, we're talking about a new kind of energy. It's an energy that doesn't have an upstream. It's an energy where you don't have to go out and explore for energy and produce energy. You simply have to build infrastructure to capture energy that is already available. And what that means is that all of the cost of the energy is in the infrastructure. And as you build more of it, you get economies of scale and you learn to do things better. So, and both of those factors drive costs down. So renewable energy is the first energy we've ever had in the history of humanity that is inherently deflationary in nature. This is absolutely revolutionary, and I think it's an underappreciated point. So it is not a question any longer of the economics not being there. And if it was only about the economics, I would say the answer to your question is incontestably yes. But there are still political blockages in many countries to the further development, and that's where investors have their doubts. But those will be overcome. Economics beats everything in the end. So I am very optimistic that we will see this trend towards greater rollout of renewable energy accelerate even outside the OECD over the next 2 to 3 years.
Thank you, Mark. And I want to apologize to everybody, including the audience. I'm doing a terrible job as a moderator for managing time, but I hope you guys are enjoying the conversation as much as I am, because it just feels heartless to stop these people in the middle of what is really informative commentary. So thank you again. And Mary, do you buy what Mark is saying? Is this something you are seeing? Have the floodgates of OECD finance opened in Asia? And if for all the diversity you mentioned across countries in your earlier remarks, for all the risks that are not unified, with no unified regulator, where do you see the market for green and social bonds in ASEAN and South and Asia Pacific?
Just for the record, Vikram, I think you're doing a great job as a moderator.
Oh, thank you for that. You get an extra 30 seconds.
So I think you know, obviously green bonds are up and coming in Asia Pacific. I think social bonds are not quite there yet. In terms of green bonds in Asia Pacific, the biggest markets are actually China and Australia, South Korea, Japan, and India. And I think what's interesting is if you look at China, which is, if you look at both the onshore and offshore issuances, it's the biggest market. But they have two parts, right? The onshore market, the bonds are issued with the Chinese green definitions. Whereas in the offshore market, because they're facing international investors, they're trying to raise international capital, then they have to issue to international standards. And last year, in 2019, China issued about $56 billion worth of green bonds, and over half of which was aligned with both international and local Chinese definitions. And you may want to know what the differences are, right? So in China, there are a few key differences between Chinese and international green bond standards. The first one is on use of proceeds. In China, you can spend up to 50% of your bond proceeds on your green project, another 50% on other working capital or refinance. Internationally, the bar is much higher. You have to spend 95% of your proceeds from your green bond on a green project. Okay, so that's the first difference. The second difference, up until very recently, China allows clean coal, and that's what Mark was saying about this transition, right? Everyone is transitioning at a different rate. And if you are a coal-reliant economy like China has been, they've been motivating corporate sectors to clean up their coal manufacturing plants and coal power plants, and that's why for a time they allowed clean coal to be on their green catalog. But recently, they've just taken that off. So we're seeing signs of convergence on that particular point between Chinese and international standards. And the third difference is on hydropower. So these are some of the key differences. But if I look at green bonds and social bonds, so what we're seeing is there have been, in the last 6 months, a little bit more interest in social bonds relative to green bonds. And the reason is because if you are living in a densely packed area like Asia Pacific, a pandemic is really, really bad news, okay? And I think for people in APAC, they're beginning to appreciate what social impact bonds can do to, for example, address inequality problems, to reduce poverty, to help provide basic necessities, and also support this small and medium-sized enterprises. And I think for the sector to continue to grow and evolve, and bearing in mind that even though China has been one of the largest green bond issuers, and there are signs that social bonds are going to be kicking in Asia, collectively, green and social bonds, not just in Asia, but in the entire world, is only a fraction of the bond market. The global bond market is in terms of trillions of dollars. Global, sustainable and green and social bonds are in the billions. So we're talking about a very small segment of the market. And I think for the market to continue to grow, to attract and convert even more investors, to attract even more capital, we need to be careful about green and social washing. We need to make sure that investors are looking under the hood. They know what standards these instruments are issued under, how the proceeds are being spent, how the impact is being measured, and whether there will be post-issuance reporting. And I think increasingly investors are looking for that level of governance. And I'll stop there.
Thank you, Mary. Martin, I'm just going to give you a last word on sort of this segment, and hopefully we'll have some way of answering some of the audience's questions. But I think one of the things that emerges from a lot of this is the whole issue around pricing that keeps coming back in terms of, the greenium, or now I don't know what the equivalent of the social bond word would be for premium, but
socialinium.
Yeah, and the green has a more of a track record. Mark has said ESG is performing better. So there is all of that. And perhaps while you're at it, you can also set us off by answering one of the questions in the audience that you raised your hand for. Is all this just old wine in new bottles? Still better than new wine in old labels. But what's your take on those two things? And then we'll come back. I'll try and formulate a question for everybody that hopefully allows you to close out. Thank you.
Of course. I think that pricing is actually the key to the development, other than obviously the economics that Mark mentioned in terms of the projects themselves. Because then the big question is, where does the money come from to finance all of these projects? And is this going to be economically feasible from the financing perspective as well, or incentivizing? And capital markets across the globe, what we've been observing, and we've issued bonds in a number of various countries, both developed and developing, differ from each other. And just go perhaps some major markets, market by market. One would say probably Scandinavia is the most developed in terms of pricing, and by pricing advantage, I mean that you can obtain a better pricing as an issuer, so potential investor in these types of projects, when issuing a green bond, let's say. And green, by the way, is more developed in that context than social and sustainability bonds, but now the pandemic is just allowing the latter two to catch up. So in Scandinavia, there is a bigger advantage in terms of original cost of issuing, as well as best track record of outperformance in the secondary markets, because there are two aspects of the outperformance of the thematic bonds out there. Then there is Europe, with vastly developed market and a lot of asset managers that have an ESG mandate. Then there's Canada, actually, where a proportion, it's not perhaps the largest market, but there is a large proportion of ESG asset managers in Canada as a percentage of the outstanding demand that you can get there. Then there's US dollar, the biggest capital market out there, and it is showing signs already of outperformance. And then you have the markets like sterling, like Australia, New Zealand, Japan, etc., as far as developed markets. And then there's the whole area of developing markets. And at IFC, we actually see already for our midterm note issuance an overwhelming demand for thematic bonds, exceeding the supply that we can provide. And it's not only a story from us, but also from other issuers, where we simply, by managing that demand, we price more tightly, which means that we get a better financing when we issue a thematic bond. Now, there is obviously a question of greenwashing and whether we can report against everything that we issue. But IFC, we've tried to actually make sure that our reports are kosher and everything is back-to-back finance. The way things are developing and the demand that ESG accounts are creating is incentivizing issuers to issue bonds that, can vouch for with their overall credit, with their overall institutional evaluation from the ESG perspective, as opposed to back-to-back reporting. And then there can be a reporting that follows. So there is sort of dichotomy in terms of the way this market is developing. One, there is an enhanced level from sophisticated ESG investors to provide a track record of financing, and then there is simply a huge demand for bonds where investors are evaluating issuer overall and not necessarily looking exactly what the money is going to finance. And then there is obviously the whole area of transition bonds, so the bonds that can finance fossil fuel related types of projects, and that these can be actually not increasing the volumes of fossil fuel extraction, if you will, but actually make them less polluting. And if you do that, then you can actually save much more CO2 going into the atmosphere than by doing something very clean in the green context of things. So this is also something that's developing in the market. The other way we try to leverage our position in the market, I guess, is we recently introduced a poll. We work with a number of underwriters, and we introduced a survey amongst the underwriters and the dealers to evaluate their overall ESG profile. And this result of that survey is being used as an input to the business then we give them as far as issuance of our bonds. And this way, we hope we can, in a way, incentivize some entities to actually change their policies. Over to you, Vikram.
Fantastic. So trying to push the metric of evaluation along the value chain, along the intermediation chain, along the placement chain. That's great. Look, if any of you wants to answer the questions that are coming to you in the chat box, feel free. We don't have much time. I'm going to ask the others to simply combine. I'm going to read out 2 or 3 very interesting questions. Find whatever aspect of that appeals to you. And please just sort of think of it as responding to the audience and your closing statement. If there needs to be one, there doesn't need to be one. You guys have said wonderful things. So I think these are very interesting questions. What are the potential impacts of COVID on sustainability in terms of risks going forward, right? In the post-pandemic world, what could be the high priority sectors for sustainable finance to sort of focus on? And then I think an important question on public finance, a lot of this is going to ultimately be public finance. What role can the private sector play, both in advocacy, in influence, and in deployment in a way that allows us as in the broader private commercial finance community to actually try and help save the day, so to speak. So I'm going to just sort of go in no particular order. So let's go with Mary, then we'll go with Dorothy, Manju, Mark, and then maybe Marcin doesn't need more time, but okay, go.
Hi, Vikram. I think the last question resonates most with me, because I think the private sector has a key role to play, notwithstanding the other actors in the ecosystem. So obviously, there should be private-public collaboration. Things can't happen in a vacuum. You need policies to coincide with the efforts that the private sector is making. And I think it is important to remember that even though we may be allocating funds from the public, we may be allocating funds from our clients or beneficiaries, these are people's livelihoods, these are people's savings, retirements, and these projects, if you are an institutional asset manager, you may be investing on behalf of your clients, and your projects, your investments need to stack up in terms of risk-adjusted return. I know that the UNEP has done a lot of work on fiduciary duty. They published a study on the 21st on how fiduciary duty is evolving in the 21st century, but it's subject to interpretation in different markets. So I've just seen a US Department of Labor directive to say that financial advisors should only be thinking about pecuniary returns when they are providing retirement advice. So for products, investments, I think whether we are an investor or a product manufacturer, we need to constantly and make sure that the products that we are putting in front of our clients are the right products, that we broaden their appeal by considering improving their liquidity, their exit options, and if we are requiring our investors to pay a premium, we need to articulate clearly what that premium is buying us, and what the value proposition is.
Dorothy?
Yes, so very quickly, for me, just also taking on what she's just talked about is the one that resonates is on the, collaboration between the public and private sector. It's only through that can we come up with products that actually, have the greatest impact. And for the audience, if you haven't read through it, maybe you should look at the Rhino Impact Investment Bond. It's one of the very innovative ones that, it covers conservation efforts at 5 sites in South Africa and in Kenya, trying to save or grow the number of black rhinos, which are, currently very vulnerable. And the yield will depend on the population group of these animals. Now, for institutions and for investors and all these parties to come up with such a product or such, a structured arrangement, that requires a lot of, collaboration. And for us, particularly, like I said earlier, in Africa, what is needed is a lot of awareness. Just making sure that all the parties involved can actually understand what ESG is and the value, and that also includes taking part in a number of these forums and the TCFD, for example, a task force on climate-related financial disclosures, the Insurer Pilot Group. It's very sad that it's only one underwriter in that whole group, at least from the Africa perspective, and that's ICEA LION. And what we are working towards is trying to bring as many of us together, knowing that we can't pull for us to succeed in this particular area and for us to build resilience. We can only do this through a collaborative process. So really just challenging my colleagues within this region, and of course, banking on your intellect, your knowledge, having gone ahead of us, even as we move towards this, climate resilience processes and climate adaptation finance.
Thank you, Dorothy, for sort of calling out the extended human-nature interface with beyond simply into the animal, the biodiversity world as well. Manju.
So I'll make some quick comments. So I think there was a question about, what are some of the areas that to focus on. One is that, human rights, climate change, and social inequality. I think these are the top three themes that we can think about as we move forward. From being a part of BMO, from that perspective, I think some of the journey, it's a journey, and you have to sort of, position yourself in such a way that you can then be adaptable and provide what your employees need. And from a company perspective, what are some of the things you want to think about? You obviously, during the pandemic, you think about health and safety, how you're interfacing and working with the customers, what's your productivity like, and how are you operating in your communities. So in terms of how then you use these, also you have to think about how you're going to train the bankers in our paradigm that we are working on, and that's a very important sort of thinking that positioning that one has to think about. And then last but not least, the public-private partnership has already been discussed, but how do we continue to build newer products? SLB, the sustainability-linked bonds that have come out are great. There's only one so far, but will there be an uptake for that? It's going to be interesting to see. And of course, transition finance is also very important as we move forward, especially for countries like Canada and others that have to continue to operate and work towards a greener economy. So with that, I'm going to stop here.
Great, thank you. Mark?
Yeah, just a final quick comment. I saw one of the questions coming in through the chat room about whether the EU stimulus plan and the green element to that is going to be adequate to the task of putting Europe en route to achieving a Paris agreement, its fair share of the contribution to a Paris outcome. I think at this stage, realistically, no, that is not the case. And the second part of the question was, or is it just going to be more incrementalism? But I think it would be a mistake to use the term more incrementalism in a purely negative way here, because I think, again, building on comments I made earlier, the most important point to appreciate in all of this, and I think this entire webinar this afternoon has been focused on this very point, is that the COVID pandemic really represents an opportunity to accelerate the speed with which we transition away from the old global energy system towards a much cleaner, sustainable system. And the importance of the European stimulus in that context is that it will help accelerate that move still further. The economics are all moving in the right direction now. What we need is, wherever possible, policymakers to iron out some of the wrinkles that are still there, the political wrinkles that prevent the economics shining through. So I think there's obviously much more work to be done to get onto a trajectory that's consistent with the Paris Agreement, both in Europe and certainly in the rest of the world. But if I can end on an optimistic note, I think the lessons we have learned from the pandemic, some of the behavioral changes that will stick at the margin, can help us really transition all the more quickly coming out of this crisis and be better prepared for the future. Climate change itself is going to be an even bigger challenge than the pandemic. It's going to be with us for a much longer period. It's going to be with us for the rest of all of our lives and future generations, and we really need to accelerate our efforts to deal with it.
Great, thank you. Martin, I don't want to leave you out, but did you have anything to add, particularly on how sustainability-linked bonds might actually be new wine in new bottles?
Yes, I'll take 1 minute on this one. There was a question about old wine and new skins in terms of the capital bonds. The thing, and I guess addressing this and how we can affect COVID-19 actually related challenges going forward. There was also a point made by one of the viewers on the the fact that the recovery will come on the back of the government stimulus that will take place. But actually, the SMEs, small and medium enterprises, and local economies are affected most in terms of potentially going out of business. And this is something that is, up to financial institutions, up to the regulators and the government to provide the support, and up to institutions like ourselves, like the multilaterals, to provide that type of financing to small and medium enterprises. And as such, this financing is provided in both the form of a loan and in the capital markets. And if you actually can get financing for this at a more attractive level, price-wise, then you can provide actually more attractive financing to these entities. So this is all actually relevant. Plus, increasing volumes and liquidity in that market increases the growth of that. And as you can see, that actually creates all sorts of cloud of demand for these types of products that then spur the growth of that market going forward. And I believe then ultimately translates into more attractive financing for these entities. Thank you.
Thank you so much, Martin. Thank you, everybody. Look, we are already over time. I'm not going to try and summarize this fantastic discussion. I just want to sort of note that we do have a window here to rebuild our world for a much more inclusive, more resilient, and a more sustainable future. Not at least help Gen Z with their huge sort of task ahead of them, and we should at least be able to support them. And not doing so is going to pose a significant threat to both the recovery, but also risk propagating these systemic shocks that the impacts of climate change are going to impose on us. So we're going to need systemic solutions, right? We are just beginning to see the tip of the iceberg, and what's needed is sort of still to come in many ways. And the private sector has a huge, key, important role to play in what is going to have to be a very deep and pervasive transformation. So with that, I'm going to thank all of our great speakers, the wonderful audience, as well as the organizers and my colleagues who helped make this a success. Have a great rest of the day, everybody. Thank you so much.
Thank you very much.
Thank you.
Thank you.
Thank you. Thank you.